Now let us look at a balance sheet and income statement which also has additional information along with it and prepare the cash flow statement. On your screen, you see a balance sheet and additional information with it. And in this case, we do not have an income statement. So there is information which is not known to us, but we have small pieces of information in additional information. So there are four pieces of information which we need to make use of and find out few missing numbers as well. Now let us use the same process and prepare the cash flow statement. The first part will be cash flows from operating activities. We start with the net profit figure and we go to the balance sheet and we see a jump of 24,000 in the profit and loss account from 2014 to 2015. So profit figure is 24,000, and now we need to add to it non-cash and non-operating expenses. So let us try and identify what can be the non-operating and non-cash items here. So we do not have income statement here, so it is not that easy as it was to just look through the income statement. Now we will need to create some working notes to identify these missing items. So let's go to the additional information one by one and analyze it. Investment costing 16,000 were sold during the year for 17,000. So let us look at the balance sheet for investment balances. You have 1 lakh and 1 lakh 20,000. Let's prepare a working note and then see what is the missing figure. So we prepare investment account, and because it is an asset, we have opening balance on the debit side and closing balance on the credit side. The opening balance given is 100,000 and closing balance is 120,000. Now the additional information says investment costing 16,000 were sold for 17,000. That means you made a profit, and this profit must have been included in the profit and loss account. Now profit on sale of investment is non-operating profit, and hence we need to reduce that from the profit figure. However, let us first conclude this working note preparation. So in the working note we have sale of investment, so it's going to be by cash. This is sale equal to 17,000, and we know there is profit of 1,000. So to profit and loss account, which means profit on sale here. Now when you total the two sides, you see that you have 137,000 on the credit side, which is higher than the debit side, and there is a balancing figure of 36,000, and this balancing figure is purchase of investments. So you have invested more money during the year. Now from this account preparation, we have found out at least one non-operating item here. This 1,000 will have to be deducted from the while calculating the operating cash flows, and this 36,000 is going to go to the investing activity, and this 17,000 as well will go to investing activities. So let's for now hold on to recording the reduction from the operating activities for the profit made and prepare the next working note. This is provision for tax, and we have opening and closing balances for provision for tax. So as always, we prepare the provision for tax account. So you have opening balance of 150,000 and closing balance of only 20,000. Now the adjustment given to you is provision for tax 18,000 during the year. That means in the income statement you included 18,000 as provision for tax. So we are going to go to the credit side of provision for tax account and say this is the provision created during the year. This is 18,000. So the total is 168,000, which means there is a balancing figure on the debit side, and this is going to be the tax actually paid. So this is equal to 148,000. This is the balancing figure here. So this 148,000 is the actual tax paid, which will be deducted from the profit at the end of the calculation of operating activities. And this profit and loss account, the provision created, 18,000, is going to be added back to the profit because this is a non-cash item. So let's go back and look for more adjustments. Let's first do all the working notes and then we will transfer the amounts into the cash flow statement. Next up, you have the fixed asset information. So you have opening and closing balances, and the information number 3 says a part of fixed asset costing 20,000 was sold for 24,000, and there was a profit which was included in profit and loss account. Again, this is profit on sale of fixed asset and not an operating profit. This has to be deducted or excluded from the calculation of profit as well. So let's prepare fixed asset account. The opening balance on the debit side and closing balance on the credit side. The opening balance is 800,000 and closing balance is 640,000. Okay, now let's look at the information again. Now the selling price is 24,000. So we have to write by cash. This is the sale, 24,000, and there was a profit of 4,000 which was transferred to profit and loss account. So profit on the debit side. This is profit on sale here. So we can now close this account and find out a balancing figure. Now looking at it, you see that the debit side has higher total. So you have over 8 lakhs on the debit side, which means there is going to be a balancing figure on the credit side. So this is 140,000, and this balancing figure here is depreciation charged during the year. This is the balancing figure. If we had this balancing figure on the debit side, we would have called it purchase of the fixed asset. Now this figure, the balancing figure, is on the credit side, and we already have sale of fixed asset on the credit side. So what is left is the depreciation, which usually appears on the credit side of fixed asset account, and hence this should be the balancing figure. All right, let's go back to the additional information. And finally, you have dividends paid 80,000 during the year. Now let's look for any other information on dividend in the balance sheet. We do not have any opening and closing balances of provision for dividend, so we're just going to assume that same amount was proposed during the year and also paid during the year. Alright, so now we have all the missing information with us as well. So let's go back to our cash flow statement and add to it non-cash and non-operating expenses which we just found out. So we just calculated the non-cash item, which is depreciation. The figure is 140,000 here. So apart from this, you have profit on sale of investment, and in the fixed asset account you also have profit. So there are two figures of profits which are non-operating incomes for the business, and these have to be deducted from the cash flow from operating activities. So we are going to say less non-operating incomes. So under non-operating income you have profit on sale of investment and profit on sale of fixed asset as well. So profit on sale of investment is 1000. This needs to be deducted. And profit on sale of fixed asset is 4000, which needs to be deducted. Apart from this, you have dividend paid. So we are assuming same provision was created during the year as well. So 80,000 dividend provision, 80,000 to be added back, and tax provision to be added back as well. So the provision for tax had 18,000. Now we can look through balance sheet again to ensure that we have not missed anything in terms of non-cash items. So if you look at the liabilities side, you have share capital, which is equal. You have general reserve, which goes up. And if you remember, general reserve is going up. The reason for this is this extra amount is transferred out of profit and loss account to the general reserve account, which means profit was reduced by 20,000, but this is a non-cash item. So we need to add back 20,000 for general reserve as well. So I'm going to write general reserve here. General reserve 20,000 to be added back. Alright, so these are the items which we need to adjust for to calculate the operating cash flows. Now after we have this, we can deduct the actual tax paid. So tax paid actually can be taken from the provision for tax account, which is 148,000. So 148,000 worth of taxes paid, and this comes out to be 253,000, and net you have 129,000. This is the amount which is the cash operating profit before working capital changes. Now we need to adjust this amount for changes in working capital, and then we'll have the net cash from operating activities. So now let's look at the working capital changes. So we're going to add to this any decrease in current assets or any increase in current liabilities, or we need to deduct increase in current assets or decrease in current liability. So let's go to balance sheet. Look at the current assets, stock, debtors. So stock goes down, debtors go up. So we need to deduct, we need to add the reduction in the stock, which is 60,000, and we have increase in debtors, which we need to deduct. This is 490,000. This is going to be a negative figure. And then let's go to the liability side and see the current liabilities. We have creditors, and that's it. Creditors go down, so decrease in current liabilities needs to be deducted. This is 68,000. The net impact of this is 498,000 in negative, and this gives us the net cash operating profit, which is a negative figure here, which means it is a net loss, 369,000. Let's now prepare the second part of the cash flow statement, which is cash flows from investing activities. So we have to look for any sale and purchase of fixed assets. So let's go to our working notes. We have sale of investment. So you have sale of investment, which was 17,000. This is inflow. You have sale of fixed asset for 24,000. This is also an inflow. Then you have purchase of investments, which is 36,000. 36,000. This is going to be negative amount because it is a purchase. And then you will have yeah, that's it. That's all the purchase and sale of fixed assets and investment. Now we can look for any amount of income earned from investments, but we do not have any information to that effect in the balance sheet and neither in the additional information. So we are done with the calculation of cash flows arising from investing activities, and they come out to be 5,000 positive, which means this is net cash inflow from financing activities. Let's now go to the third part, which is cash flows from financing activities. So let's look at the items in the balance sheet one by one. Share capital, there is no change in the share capital, so nothing for our use in the financial activities. And there is mortgage loan, which is going up, which means an incoming cash flow, so 540,000. Loan raised 540,000 here, and yeah, that's it on the liability side. We can look through the additional information. So investments are taken care of, sale and purchase both. Provision for tax has been taken care of. Fixed asset purchase sale has been taken care of. You have dividend paid 80,000. So this is financing activity. Dividend paid 80,000, and this is an outflow, so a negative figure. So apart from this, you can look through the working notes again to ensure that no item has been left unrecorded. So yeah, we have included all the relevant items. So this gives us net cash inflow of 460,000 from financing activities. Now that we have cash flows from all three activities, let us find out the impact on the cash position. So net cash inflow or outflow. So we can sum up all of this, and we have 96,000 as net cash inflows, which is a result of the three activities combined. So we had 369,000 as cash outflow from the operating activities, and then we had cash inflow of 5,000 and 460,000 respectively from investing and financing activities, giving us net cash inflow during the year equal to 96,000. Now we need to see whether the opening balance and closing balance of cash reconcile to this. So opening balance of cash or cash equivalents. In the balance sheet, you have 298,000 of cash in the beginning. So 298,000. So you had this much cash in the beginning, and during the year you earned 96,000 cash more. That gives you a total of 394,000 as the closing balance of cash. And if this is equal to the closing balance of cash in the balance sheet, your calculations are fine. So let's look at the closing balance, which is 394,000, and this tells us that our calculation of analysis of where cash went and where cash came from are correct. So basically what we did in this process is we broke down the various sources and various applications of cash into three major activities: operating activities and financing activities and investing activities. Now we know there has been a change in the cash position to positive effect by 96,000, but how did this 96,000 come into place? We know now that operations of the business, or the primary operations of the business, contributed negatively to the cash position. 369,000 worth of money was actually went out in the operating activities, and it was the financing activities which brought in a lot of cash during the year. So using this information, we can analyze the cash position of the business and take better decisions going forward, which can help the financial health of the business.